Good morning, folks, and welcome back to Almus Market Mornings. While the war is still going on, the start of this week is a bit different. Last week, we saw rupee weaken to its weakest level, but during the weekend, there have been an interesting measure taken by the RBI. The measure said that the authorized dealers, or essentially banks, must maintain their NOP INR position in the onshore deliverable market within $100 million each day. What does this mean? How does it impact the rupee? Let's understand from JK. Good morning, sir. Can you break this down for our listeners?
Good morning, Swaraj. I think we have been anticipating some sort of a measure from the authorities other than direct intervention to address the one-way move down in the rupee. Of course, I was thinking whether they would go in for something like an FCNRB scheme that came in 2013. But they have come out with a new regulation or a directive, I would say. It's not a new regulation, it's a directive. So, what has happened is that banks normally run open position up to 100 million as permitted by RBI. And somewhere in 2020, banks were also allowed to take any position on long or short in the offshore market as well. Now, when they create a position in offshore, it was being matched by opposing position in the onshore. So they would maintain a net open position of 100 million or less, combining both onshore and offshore position. Now the new directive from RBI has indicated or has actually told the banks that your onshore position alone should be within the permitted limit of 100 billion. Sorry, I'm sorry, 100 million. So this is a big change, and because of the earlier regulation which allowed them to take position in both the markets, offsetting position, now suddenly they would be open very long position in the onshore market, which they will have to unwind. Some conservative estimates say it could be at least $20 billion, and this will have to be unbound or sold back in the market before 10th April, by when the position has to come below 100 million for all the banks concerned. And it's a very big amount that the market, even in this bullish market, it's difficult to see it getting absorbed unless the rate goes down substantially. So there will be pressure, selling pressure from the banks, unless RBI tweaks the rule in some manner to help the banks, because banks who are into this, who want to unwind locally, they do not know what rate the offshore will quote for buying back the sold position there. So there may be some losses, or maybe it may be even substantial losses for the banks. So whether the RBI will tweak the rule to some extent is something that we have to wait. Otherwise, nothing happens. Dollar rupee will go down. It has already gone down in early offshore trades in Singapore, which is like below 93, and it could down even more. See, this 93 has come even without much volume happening. That is what I can say. And if actually volumes go through, it can go even lower, something like 92. But that apart, this is not a change in fundamentals that is driving the dollar rupee higher. War is still very much on. The oil supply and higher oil prices still govern the economies which are affected. So we, at some point, I would say that there will be enough buyers who can absorb this selling by the bank. It's just that in the short term, it can be one-sided, sellers more and buyers less. At some level, it will match. I believe that level could be somewhere around 92 or slightly below that, but we'll wait for that. And since the banks have time till April 10th, as of now, an initial selling may stop at some level, and then you can see buyers coming, and it can become a two-way market slowly later on. But to reach the Friday's high of 94.81 or whatever, I think it will take much longer for the market. So this is the dynamic that we need to watch. And side by side, of course, we have to keep a watch on what's happening on the war front as well. If we have some relief on the war front due to some negotiation or anything, it can add to the downside move in the dollar rupee. But I think there are no such indications as of now. In fact, there was some media saying that Pakistan is preparing to host peace talks between US and Iran, but actually there is no indication that the parties are going to join. In fact, the statements from Iran indicates that they are still in a firm stance, warning that they will retaliate if US ground troops, which are moving towards the region, are deployed, and rejected the proposal, and which is seen as demanding a surrender from them. Other undesirable level, developments have been that the Houthis have actually signaled that they could join the war in support of Iran. That becomes a wider conflict, and then Iran itself has threatened to widen the war with the prospect that it can target other routes in the Red Sea, through which the oil supplies pass through. So there is no relief from the war front. Oil still trades at near 110 now, more than 3% as the Asian markets opened, and stocks are down all across. In fact, what you can see is that most of the markets, major markets, have actually lost more than 10%, which means they are now in correction territory. Between 10 and 20, it's still considered as a correction territory. So we can see more falls if there is no relief from the war news, and economies every passing day puts further pressure on the concerned economies as well. In fact, we have received OECD inflation projection, which has now put up the inflation projection for most of the countries quite a bit, including India. For India, for 2026, inflation is projected at 5.1%. For US, it is at 4.2%. Currently, we know that it is at 3.1%. So this is a dynamic that will rule the market moves. And of course, if you look at the stock markets also, in the Nasdaq, which was holding up for some time, has actually also surrendered most of its gain. And the Mag 7, which are actually holding up market for some time, have given up most of a lot of gains that they have given. For India, other than the rupee part, for which we are into a new situation, there is no relief from FI selling, which has already hit almost 14 billion in the equity market for this year, and overall about 13 billion, highest since March 2020. This is notwithstanding the fact that the PE valuations in India have actually now hit the May 2020 level. Last time when there was a sell-off from FIs and overall market. So whether this invites fresh inflows from FIs, very difficult to say, because they will not go purely by valuation unless the full impact of the war on the economy is discounted. I think FIs will hold off for the time being. We are not even seeing slowdown in their sales, which means that is this pressure will continue. All eyes on how the rupee behaves. Just for a perspective, today, of course, we are in the last day of the financial year. We are probably closing around 92 or thereabouts, very dynamic in that regard. But even if we are closing at 92, from the March 25 level to March 26 level, we are more than 10% fall or depreciation in the rupees, what we have seen. Let's see whether the next financial year holds a better time for the rupee. Thank you.
Thank you, JK. And yes, I think this has been some long time coming. In our podcast and reports, we have been discussing about possible measures the central bank can take to sort of curb this one-way move in the rupee, and it has now over the weekend, and it has caused a lot of turmoil. We are seeing in the early opening trade, as we record at 8 a.m. Today morning, we are seeing dollar rupee already below rupees 93. So that's the quantum of moves we are seeing. It's going to be a choppy one today. There are some estimates that $40 billion worth of trades will need to be unwound. But in all of this context, remember that the underlying fundamentals have not changed. What is still going on, oil prices are still high. FII flows continue to be scarce. That's the broader theme. But the kind of move we are seeing right now that can persist for some time. It can be a one-way move as positions get unwound. So we'll need to take care with respect to that. Apart from that, globally, OECD has projected higher inflation for most of the countries, and looks like uh, it's a risk of sentiment in early Asian trade today. That's it from us today. Thank you for listening. It is going to be a non-active week for Indian markets, 31st, 1st, and then 3rd for Good Friday. So we'll see you all on 2nd, Thursday, with a fresh round of updates. Thanks for listening.